All right, everybody, welcome back to another episode of the Discovering Multifamily Podcast. I'm one of your hosts, Anthony Scandariato, here with Red Knight Properties. And today we have a special guest here with us, Victor Bell. And Victor has transacted over $60 million in real estate in 7 states, including Hawaii. So that's pretty interesting. Arizona, Texas, North Carolina, Las Vegas, Ohio, and Michigan. So he's got, a lot of transactional experience. He's the author of one of Amazon's #1 bestsellers. It's called How to Create Wealth Through Investing in Apartment Buildings. And he's been doing this a while. I believe you have a fund set up, right, Victor?
I do. We have a fund.
Yeah. So I'd love to get into the conversation of how funds, when you're looking to acquire commercial property, are different than deal by deal, and sort of some of the opportunities you're seeing, whether your fund is an open-ended fund or is it, with discretionary capital, non-discretionary? I'd love to hear a little bit more about how your fund is structured.
Sure.
We're recording this in the first quarter of 2023. So we were just talking beforehand on what opportunities he's seeing. There's a lot of volatility in the market. So would love to hear your perspective and what kind of funds, how many funds do you have? And, what are you looking to do with the next fund you're setting up?
Absolutely. So, I got started just like everyone else. I was kind of buying properties. I learned, short, skinny on myself, got out of the military, dropped out of the free college, and got in trouble, had to get a job, and got, realized, okay, everyone at that job hated their job. People who had been there for 10 years hated it. I was new, as well as a few other people were new and they hated it too. So that first year I did about $1.2 million in real estate deals, but I didn't really know what I was doing. I kind of stumbled my way into it through really necessity. So, this brings me to the point of the fund. So a lot of times, all real estate investors, especially when you're doing it either full time or it's kind of your side gig and you're putting your toe in the water, you're kind of like, find the deal, find the money, and then do the deal, make some money, clean up a mess, learn what you didn't know prior to, and take that money, live off a little bit of it, and then score your next deal. Like that's a weird cycle. So about 3 years ago, because we moved here from Hawaii, it's been 4 years now. So 4 years just this past December, it is what it made for us. We sold our last apartment buildings in Hawaii that we had. So we were there for 17 years. I bought a lot of residential and multifamily properties. Primarily multifamily is my bread and butter. But it made me realize, like, I didn't have a money problem anymore. I had a cash flow problem, and I had made more money off of my apartment building deals than I did on single family house deals combined in 5 years. So it was an eye opener for me to, like, you need to stop dabbling. It's okay. We're not going to turn down money, right? Because you're a real estate guy. Most people listening, they do deals. So like, you're not going to turn down $100,000, $200,000 deal, profit. But that cycle, like that fight and flight cycle, it goes away. So when we got here, I started taking a look at some bigger deals than I was able to look at in Hawaii. If anybody knows the Hawaii market, man, it's a tight market. I did deals there for 17 years straight, as well as other markets, but I made primarily most of my deals in Hawaii. Moving here, you got bigger deals. It's a bigger place. It's not an island, right? And I'm in San Diego County. Love it. I love it here. So I started realizing, like, okay, in order for me to play this game and play a bigger game, because I didn't want to do the same thing I did before, like the 10, 15, 20 unit deals in Hawaii, is still an expensive property. But 40, 50, 60, 70 unit deals here, it wasn't one of those deals where you're just going to go to a seller or a broker and say, hey, I want your deal. And they're going to be like, yeah, I know, we need some money. Hawaii too, but it was more evident here. So, I went back to my investors and I was like, hey guys, here's the deals. I'm able to find the deals. They're great deals. We got some capital, but here's what's happening. And every one of them over this last few years, because I'm sure everybody's experienced it, money was flowing freely. Deals are easy to come by, and everybody was kind of like, making a lot of money fast. I was like, I had to re-educate my investors, because they're like, well, we got to get this for cheaper, and there's other deals here, and we got to get this. And I was like, guys, that's going to stop. Like, real money is not flowing into some of that's an inflated situation. You're going to have to look at bigger deals, and you're going to have to tighten up the screws on that old way of doing stuff. And slowly but surely, and I'm sure everybody's experiencing it, you can see it. You're like, hey, money's, it's not today's rates. It was just maybe last year or so. Those bigger properties were getting snapped up by the big guys. So guys like you and I, the underdog guys, there was no way we were going to get those assets. And now the deals that we look at, because I started a fund, I was like, all right, how do we do that? How do we move away from transactional beginning phases to middle ground phases where I'd already kind of succeeded there and was moving into bigger deals and having to go back and say, we need a whole new pool of investors, somebody who's now just an investor, somebody who understands returns, somebody who wants to do deals and doesn't want to do the work, but they want to be in more stable multifamily properties in really a better market than just some of the submarkets that a lot of people want to look at, because those deals, and some of those, I call them lower price markets and a little slower markets. They're going to be harder to come by, and they're going to be a lot harder to get out of when guys like myself, and probably like other people who are listening are like, I want to start a fund, instead of just doing a syndication where it's the same thing as finding a deal, raising the money, and then doing it all over again. It's going to be a lot easier for somebody like myself who's like, look, I'm shifting hats. I'm taking this hunt hat off, and I'm like, hey, we're going to raise capital, and then we're going to deploy that capital into good properties, and we're going to keep raising money and keep getting good deals. We're over that hump of just trying to scratch it out. The first 20 years, fine. You gain some experience, and it's, it's a badge of honor, to go out there and fight the good fight. But at some point, the next 20, 30 years of anybody's investment career, you go, I didn't get into business to buy 10, 20 unit buildings. We got into business, real estate, to be like, man, who owns that monster across the street? How do we get that? And I wanted to figure that out. So, I started a fund to do that.
Right. Okay. So the fund structure is relatively right now in your career new for your moving
Yeah, this
forward.
this
Okay.
is our first fund. It's a $50 million fund. It's a accredited only fund. It's a 506c. That's how we structured it. It has the basics, the 80-20 split. We had our initial, all the different waterfalls that people like to put into them, but they're really confusing. I mean, if you've been in that space, like I wasn't, to be like, hey, we have this and we have these performance fees and this stuff. I just want to have a good conversation with people to say, hey, look, this is the split. It's 80 to our investors, it's 20% to us. We had a preferred return. We actually went back and amended our fund and took that away because it was all over the place. This was when like people were worried, and they were like, and I was like, hey, banks aren't giving you guys these type of securities. And I'm watching a lot of my buddies who had syndications who had like 6%, 8% pref returns. They were getting strangled, and they were struggling with their syndications. And they were like, hey, we got to exit this deal. We're not even going to make any money. We have to get all our profits away to our investors. So as I started watching that, I was like, okay, well, that's a problem. And I think that's going to be an issue later, which is the deals that we're looking at buying. Like, who's getting strangled that has no capital that we can buy a deal with my investors and make the deal work and still help out our syndication buddies, but yes, it is our first time fund. We have a bunch of money circled from our investors. And right now we just targeting the right deals. This is a great time for deals that really weren't available just last year because it didn't pencil.
Right. And are you seeing, for our company and what I'm looking at too, I'm looking for some opportunities, seeing some of that, but it's not yet. What are you seeing?
I'm seeing it because I'm looking at a lot bigger deals. So for example, there's a deal that we went after. I won't go into the details of the deal because, the size of deals we look at, confidentiality stuff, but it is here in San Diego. Great deal. When a deal hit us, we were like, wow, man, this is an awesome deal. We underwrote it. Guidelines on that deal were in the mid 70s, 75. Literally we walked the site, loved the property, had some partners fly down. We were going to just take the deal down, just the two of us, not in the fund. And we circled back when we sized the debt and we got the debt quotes and all that other stuff back. They underwrote it like 65 and then it dropped again. And we were like, okay, cool. When we underwrote it, we are like, hey man, we're coming in at 58. We love the deal. And it's not about killing the deal. Nothing changed. The debt changed it. So to your point, yeah, we are like that deal went to call for offers. It didn't trade. It's going to come back up because the seller at the time didn't have to sell. I think he has another 12 months on his debt, to kind of like his rate cap. But that deal going from 75 to 58, that's the opportunity. But if you can't play that game because somebody doesn't have a fund, they don't have the dry powder, they don't have the connections with people, the brokers, to be able to see those deals. Look at the delta between it. Now, somebody just gets that same deal at 58, hypothetically, right? And waits it out for a couple more years because it does support there. And they just keep managing the property and doing whatever they need to do to the rents. This is not a value add deal. This is a great asset. I mean, there's some light rent raises needed. And as the rate comes back down from 6.7 or whatever it is now, on the capital side, on the debt side, back down to, let's say, 4, the cash flow shoots back up, value shoots back up. It's there. But to that point, those opportunities are coming, but we'll miss them unless you're already sitting on the other side. And I've been telling, my guys this. I'm like, look, if you don't have a fund or investing in a fund or some form of syndication over the next 3 to 5 years, you won't be able to get a good deal. It's the little guy, the underdogs who are going to be left with deals like myself that I'm like, you know what, we passed on that deal. It's too small for us. Somebody else will get it. It'll still be a good deal, but they won't be the deal that's going to change your life, right? That's going to help mine and your kids graduate college later when we're gone. And that's really the phase where I'm leaning into in our business as it relates to Bell Capital is concerned. So this is the first fund, but I'm probably going to do 10, 15 funds because I'm going to continue on with this because, this is what I do full time.
Right. And can you talk about the infrastructure for your fund? Because I know there's, you mentioned 506C. We don't have to get into all that hoopo. We don't have the time for that. But can you talk about some of the infrastructure? Like, don't you need a fund administrator?
Yeah.
So you have all that. Is that okay?
Yeah. So you need all that stuff. Like, this isn't like, this is a team sport. You're going to have your investor relations team, your acquisitions team, your fund administrator, your accountants, attorneys, all the people who are going to be involved in this stuff, people who need to be doing your audits and stuff like that. If you need audits, whether you're doing it because you're doing like a cost type of audit, or you're doing it for a white glove situation for your actual investors, as well as, we have some people that we partner with to even talk to people that want to invest through their IRA, as long as they're accredited. So like, you have to have all those things set up, and it's not inexpensive. That's always the thing, right? It's like, oh, maybe I'll kind of dabble like this, when you do something like this, it's a full commitment, which is why, it keeps a lot of people out because there is a cost, right. So I put my own money into it. Even not knowing, I was like, all right, well, I don't really understand all that stuff, but I'm going to start the fund. Some people don't do that. They do a reverse. They go get money from investors and then do a, promissory note, a convertible note, and say, okay, well, when it's all said and done, we'll get this and you'll be in it then. But I wanted to do that because I knew I was going to my partners and investors and saying, hey, we're going to be doing this. Do you want to be in? My money's already in. I'm the first investor. Right. So, I mean, I'm trying to shorten that because, you're right. It can go super deep. We can spend hours on that stuff. I'm talking about the structure and who needs to be involved, but all those people need to be in play. Definitely.
Right. And you kind of talked about some of the archetype sellers you're going to go after in order to capitalize on for this fund. What does the risk profile look like, and how long of a duration is a fund versus, like you said, a one-off deal with the syndication? Is it similar, or because a fund is a fund? It either has it has one life basically, in terms of the length. Each deal on a deal by deal basis could be separate and all different, and have different maturities and whatnot. So at least in, like you mentioned, in that sense, setting up the fund versus deal by deal is a lot less headache because okay, I have a 5-year fund or whatever your time is. Yeah. And that's when everybody, needs their money back or whatever. Then the profits, as opposed to, oh, I got this debt maturing on this date, and that property's maturing on that date, and we closed on it on this date, and I got to sell it on this date or refinance it. So that also helps in terms of why you set up the fund. Yes. But does the fund have any duration on it?
Yeah, it's a 7 to 10 year fund, and again, 7 years is about right. And the reason I don't know if people know this, but typically on commercial financing, your financing is set up 3, 5, 7, 10, and you find other ones that are, some stretched out 12 to 15 years. But this fund is set up between 7 to 10 years. And the reason why is because we're going after bigger deals, and those deals, to your point, have to mature. So let's say we get a deal 3 years and we're going to be raising the rents and making sure that after raising the rents over, well, let's say 24 months, we have 12 months worth of maturity on those rents, right? Stabilization. We may go back and take a look at the debt at that point, depending on the debt and how we structured it, and say, can we refinance all of our investors' capital out, give them their capital back, which is what I've done in the past, and just leave them in the deal, and we still hold that deal for 7, but they've got no more money at risk. So we de-risk our investors. So I've done that in the past. And then we just turned around later, and when it was time, sold the property for double or triple what we had in it, but we had no money in it anymore.
Right.
Now it's just a cash flow play for us. So that's the strategy for us as it relates to the timelines. And when we're looking at maturity per property, I personally like the fund structure better, because in my head, I'm like, all right, if you have more than one property in a fund, there's your diversification. And for me, I'm trying to find the same type of property, the same quality of property to have in one fund. So in this fund, we'll probably have 2 to 3 deals in there, but it's going to be the same caliber. I'm not going to go B property and a C minus, right? I'm going to go B property and a B property that we can raise to a B plus. So even though, to your point, we'll have that maturity of each type, we're still looking for the same type, and then also the same timelines. So, right. Because then we're looking at, not affordable. When I say affordable, I don't mean low income, but let's say rents are still affordable, $2,000, $2,200, $2,400 here in California, right? That's still affordable to people. And if we're looking at raising rents across the board, then that's going to be the consistency of our total product, right? Whether we have 2 properties, 5 properties, 10 properties across 4 or 5 funds, and naturally they'll transition out. But that's my first plan, naturally, is always to do what I've always done, which is refinance, take the capital out and pay my investors back. And then they just sit in the deal, which they all like that.
Yeah, no, who wouldn't like it?
Who doesn't like
awesome.
their
And you could de-risk it and then hopefully use that equity. It depends upon if you're still raising money for the fund, but you can use it to fund future deals in that fund.
Right.
Which is
and that's
awesome.
if they want to keep going, which they do. And if not, it's okay. Like, they're still in a deal. Like, it creates assets it's a win for them and also a win for us, because again, we're building something long-term for people so they can generate wealth, create wealth, as opposed to just like, I'm having a one-off deal. So that's the difference. And it's a structure that we wanted to take that made sense for people, because we can understand that.
Awesome. Yeah, no, that makes sense to me. I know we're short for time, so really appreciated the conversation. How can my audience find you?
Sure. You know what? Honestly, you can go to bell-capital.com. That's our website. You can schedule a call there, or you can invest. You can take a look at the fund, the docs. If you're accredited, you can see, the structure. You can also go to bell-capital.com/book. Get a copy of my book. It's good. Not too much glare. Good. You can get a copy of the book, the digital copy, costs you nothing. Just download that. Love to have you take a look at it. I did that because, people have questions, the terms, what they're looking at, how I think, why I'm looking at stuff, or they may want to do it themselves. It's some information I wish I had. Or you can Google me, Google Victor Bell Real Estate or Victor Bell Capital. You can find me on Facebook, Instagram, Twitter, LinkedIn, all of those ways. And again, I do enjoy helping people. I love talking to people. I started off calling someone and asking someone to help me because I didn't ultimately know what I was doing, and they put me on the right path. As a matter of fact, one of them is my business partners inside of Bell Capital right now. She's my investor relations manager, as well as she does some of our accounting, Jamie. So, but when you say reach out, I mean, I really mean it. I definitely want to help people. So please reach out. If you want to invest with us, let's talk. Let's find out what you're looking to do and find out if it's a fit for both of us, because we love to have you a part and be a partner with what we're doing.
Awesome. Well, Victor Bell with Bell Capital, thanks so much for coming on our show. I will have a link to Victor's website as well as the social media platforms in our social media and on iTunes. And if you liked what you heard and or saw today, please give us a rating and review on iTunes. It would help Victor and myself get our message out to a bigger audience. It's just the way the algorithm works. So we really appreciate that. And thanks again so much for coming on, Victor. It was very, very useful.
Hey, thanks so much for having me. I really appreciate it. And I definitely want to help get everybody to take a look at the podcast. I love your episodes. I love what you're doing. So any way I can help out, let me know. I really appreciate being here.
Thanks, Victor.